Hello, I'm John Freechak. This is Al Offenberg. Welcome to our next segment in the Need to Know series. Al and I get together at least once a year to talk about what our clients should be thinking about, trends we see. And this year, Al, I think we came up with a little bit more positive. I think we're hearing better things from the bankers that we deal with. What we'd like to do is talk about three things today. One is that patience and being prepared, we think, will ultimately be rewarded. We're going to talk about low and no premium deals. Think that that's a trend. Al is going to has some pretty good comments on that. And then finally, what we try to do is talk about regulatory and a governance update that we'll talk about a couple of things that each of our clients have been seeing.
As we look at this year and looking out further, post-financial crisis, one of the things that we see that's really going to help drive M&A is really the board of directors. A lot of the board of directors in the community bank side, we think are going to help be the drivers or the catalyst to help really cause the merger consolidation to continue. Over the past years, we've seen it be in the more management side and the shareholder side. We always think it's very important to have an acquisition list ready at the ready. And if you're a bank, and this could be something that's 6 months, 24 months, or 48 months out, but as you look at it, are there preferred acquisition targets in your market? Usually every board and management team, when they think about the landscape, there are certain competitors that would be a wonderful merger partner. And so that's good to have them on that list.
I mean, some people think that, you know what I'm going to do? I'm going to go have lunch with a bunch of people. Do your homework first. Sit down, run the numbers, understand what the pros and cons are, understand what it is you want to do. But also understand that as you were talking at the cocktail party, as you're talking at lunch, as you're starting to talk about cultural issues and gee, maybe your board would be this and our board would be this, that is in fact the beginning of a negotiation, and make sure that you understand what your goals are, otherwise you may blow the some of the points that you might otherwise be able to get.
And at the end of the day, think about this is human nature. Sellers, even when they're challenged sellers, don't want to be forced to do anything. And that doesn't matter if you're a banker or any individual that we're talking about. If you're an adult, if you're a teenager, it doesn't matter. Nobody wants to be forced to do something. They want to choose to do something. So you have to think about that patience as a buyer or a merger partner to be able to allow the seller to get to the right conclusion at their pace.
More and more, what we're seeing are low premium deals, no premium deals, no longer some of the multiples that were talked about. And these really, I think, are akin to mergers of equals.
If you look at the efficiencies of a larger organization, sometimes we used to say 1 + 1 = 3. In this environment, sometimes 1 + 1 might equal 2. Just because what it is, it's about combining two entities that can actually survive in the new environment. Clearly, regulatory costs are going up. You're in a situation where it can be very helpful.
Don't underestimate your board of directors. Don't underestimate the fact that certainly a lot of the deals that we've been involved in, the boards are much more active and they really are calling the shots. I think in the cycle back in the 90s, certainly, a lot of management were making the decisions as to whether or not deals would happen.
So what board members really need to think through is, if we, on a standalone basis, what practically, realistically can we accomplish to the shareholders? And then, is this offer better than that standalone? And is that offer better? And it really comes down to that investment decision, and that's how it really boils down to.